Silver, when we've seen rate cuts start, has been up 32% over the next 24 months in the last three rate cutting cycles. From the bottom of the silver price, over whatever that period was, from bottom to top, over the last three rate cutting cycles, if you look at the bottom of the silver price, which was usually about the middle of the rate cutting cycle, silver averaged a gain of 332%. So what is it going to do in the through this next rate cutting cycle? Well, we will certainly have to see what it brings.
Central banks are turning on the money printers, and experts are certain that the coming liquidity pump will be extremely bullish for safe haven assets like gold and silver. Peter Krauth, a renowned metals analyst and big silver bull, is certain that silver will massively benefit from the Fed's rate cuts and the yet-to-be-announced stimulus packages. Experts like Krauth cite the example of what's happening in China, where the People's Bank of China has just announced a massive stimulus package to reverse the faltering economic growth in the world's second-largest economy. Over the weekend, 2 of China's largest cities removed all home-buying restrictions. This announcement came just after the PBOC cut interest rates and announced new funds to support the stock market. It also reduced the amount needed for mortgage down payments. In response, China's main stock market index rose nearly 9% overnight Sunday, the largest single gain recorded since the Great Financial Crisis. Since the U.S. announced its first rate cut in 4 years last month, the market is pricing in another 25 to 50 basis point rate cut in November and full-on stimulus package announcements before the elections, or, at the latest, by the first quarter of 2025. While speaking at the Metals Investor Forum last week, Krauth notes that the Fed's sudden, if somewhat expected move from hawkish to dovish will positively impact silver's prices, taking the gray metal from just above $31 to triple digits. In addition to central banks' actions, Krauth highlights some core silver fundamentals and how everything points to a coming explosive bull market for the gray metal. We will present clips from Peter Krauth's speech at the forum. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. You can also check out our other videos on gold, silver, and other metals and commodities. We appreciate the support and hope you enjoy the video.
The last 4 years, deliveries of silver out of the COMEX have been high and growing. COMEX down. The end of the arrow is when I talked about this the first time back in March. We've seen that they've continued to stay low and fallen in the COMEX. LBMA has stayed sideways. This is in London, silver inventories. Shanghai, they fell. They actually spiked a little bit recently, which is kind of curious, frankly, but they've stayed historically low as well. This is a really interesting statistic. In 2019, the above ground known silver supplies, if you just look at inventories on the exchanges, was good for 163 years based on forecast total demand growth. You fast forward to 2023, and that goes back to what I said back in March and I just talked about. We only have 2 years of above ground inventories for based on current demand growth. So it has just changed dramatically in a matter of 4 years. Silver is the next uranium. I've said this before, but this interesting quote from Jeff mentioned yesterday, Gehring and Rosenzweig. They had a few years back the single best performing and one of the largest commodities funds in the world. When I read this, I thought an amazing parallel for silver. They say 5 years ago, we became uranium bulls. The market had quietly slipped into a structural deficit with reactor demand outstripping mine supply. Fuel buyers used so-called secondary supplies to fill the gap. So that is, I believe, the exact same thing that's going on in silver. The big industrial consumers are draining the silver ETFs and the silver futures markets to get the above ground silver. This shows a world silver price, so an average of currencies from around the world. That's the gold line. The blue line is the US dollar silver price. So the gold line is what most of the rest of the world on average sees as the price of silver. They've seen it rise a lot more than we've seen it rise if we're watching the US dollar price. So a lot of silver holders around the world are I guess you could say maybe happier in terms of what's happened with the silver price for them. Silver, when we've seen rate cuts start, has been up 32% over the next 24 months in the last 3 rate cutting cycles. From the bottom of the silver price, over whatever that period was, from bottom to top, over the last 3 rate cutting cycles, if you look at the bottom of the silver price, which was usually about the middle of the rate cutting cycle, silver averaged a gain of 332%. So what is it going to do in the through this next rate cutting cycle? Well, we will certainly have to see what it brings.
During his speech, Krauth highlighted that silver is entering the second phase of a long-term generational bull market that began in the early 2000s. Unlike past bull markets, Krauth predicts that silver prices will rise significantly in 2024 and beyond, driven by deteriorating supply-demand fundamentals. This forecast aligns with reports from the Silver Institute, which has documented a silver deficit for 3 consecutive years, since 2021. The Institute expects this deficit to grow further in 2024 and continue over the coming years. The primary driver of this trend is increasing industrial demand for silver, particularly in sectors like renewable energy, solar panels, electronics, and battery technology. As more industries adopt silver-dependent technologies, the supply strain is expected to intensify, pushing prices higher. Krauth's outlook suggests that the structural deficit in silver, combined with rising demand, creates a favorable environment for long-term price appreciation, which could benefit investors positioned in the metal. During his speech, Krauth also discussed the global macroeconomic environment and how it is a perfect setup for silver prices to skyrocket wildly. According to the renowned analyst, the massive global debt, skyrocketing global debt to GDP ratio, and generally gloomy global economy are all recipes for disaster for the fiat system and dependent assets like stocks and bonds, but very bullish for safe haven assets like silver.
Global debt. This is a new milestone. Globally, debt has reached $315 trillion. Seems like it's setting a new record almost on a daily basis. What's maybe more important is the debt to GDP ratio, which is still at close to a record high, 333%. It's down from where it peaked in early 2021. But if you look at where we are pre-COVID, we're still above those levels, and it's just started to trend up once again. So certainly not a reassuring scenario. This is an interesting chart. U.S. total public debt, 1970 to today. And when I first started looking at this chart, what really sort of stood out at me was, first of all, these gray bars are recessions. And so as we come out of recession, you have government stimulus. And that, of course, adds to and increases the public debt. So what I noticed was that each time you came out of recession, especially the last 3 major recessions, so 2000, the great financial crisis, 2008, and then more recently 2020 COVID, each time we came out of recession, not only was public debt increasing, but it was increasing at an accelerating rate. And that's why you see these red arrows getting steeper and steeper and steeper. So more than likely, we're entering a recession very soon. That's my view, perhaps the next 3 to 4 months. So it'll be very interesting to see when we come out of that on the other end, what public debt looks like, how much it's been added to at that point, and at what rate it grows. This looks at U.S. debt to GDP ratio, 1965 to 2021. So what's interesting is in the 1970s, we were at much, much lower levels. We're talking about 35% debt to GDP, which obviously made it a lot easier for someone like Volcker, who was in charge of the Fed at the time, to be able to raise rates to kill inflation. Try and imagine that happening today, raising rates to 18 or 20%. Almost completely impossible. Back then, it was possible for even a matter of a few months. The debt being so much lower, the Treasury was able to sustain that for a while, pay interest at these much higher rates on debt in order to, as I say, to kill inflation. But you could certainly not have that happen today. The amount of printing as it is already just to service the debt is already off the charts. So imagine trying to see that at much higher interest rates. Highly unlikely that we're going to see those kinds of rates, at least Fed-determined rates anytime again soon. Now, inflation is becoming structural, and I believe this is happening for a number of reasons. If you look at the period since the financial crisis, so say 2008 to about 2018, 2019, we had a decade of inflation ranging around 2%. But since COVID, and we've had this new giant wave of inflation, we now have these contributing factors. For example, labor, which has a much easier time negotiating with less people participating in the labor force, gaining and getting the salaries that they want. They have a much more bargaining power. Globalization, to some extent, has pulled back, in some ways has ended. You have a lot of supply chains that are now looking to source things more locally. They don't want to fall into the risk that they had when COVID hit, and all sorts of supply chains fell apart. The energy transition is another factor that's affecting inflation. We've got all these governments and companies that are moving towards net zero. It sounds like a good cause, but certainly comes at a cost. And so that's likely also going to, on an ongoing basis, add to inflation. And then the last one is defense spending. Well, we're looking at right now a few wars are already ongoing around the world. Countries are getting more and more cautious and conservative, upping their spending budgets. So you have all these factors that contribute to what is likely going to be structural inflation that's going to be more in around the 4, perhaps even 4.5%, despite what we've seen in the last, say, last year or even 2, where it's come down. I don't believe that's going to be sustained. This chart shows the returns, the real returns on a U.S. 60-40 portfolio, 60 stocks, 40 bonds. Well, what's interesting is that if you look back at the periods that were challenged, most obvious one is the 1970s, most recent. And during that decade, you had a -3% annual return and a net real return in that portfolio. So if we are indeed moving into a new inflationary environment, it's going to be a lot more difficult to produce real returns in your portfolio. And that's why I believe commodities that are an inflation hedge are going to be an important portion of any portfolio.
Several market analysts are forecasting a potential mania phase for silver, a period of rapid price escalation and market frenzy. David Morgan, a prominent voice in the precious metals space, refers to this as the Great Silver Crisis, predicting that silver prices will skyrocket to correct years of paper money inflation, price suppression, and ongoing supply shortages. According to Morgan, this scramble for silver will act as a reset for the metal, reversing 2 decades of bearish sentiment and fundamentally altering its valuation in the market. Peter Krauth supports this view, calling it a mania phase that he believes will unfold over the next 12 to 18 months. His reasoning stems from the depletion of silver inventories and increasing industrial demand, particularly in sectors like renewable energy and electronics. This could push silver prices to unprecedented heights once supply is insufficient to meet demand. These predictions suggest that we are on the cusp of a major shift in the silver market. Analysts are pointing to structural deficits, heavy industrial usage, and decades of price manipulation as key factors contributing to an upcoming surge in silver prices. Do you agree with Krauth's assessment of the silver market? Will silver experience the mania they're predicting? Drop your comments and observations below. If you enjoyed this video, please give it a thumbs up, subscribe to the channel, and check out our other videos on precious metals like gold and silver. Thanks for watching, and we hope to see you in the next one.